What if I told you that 2026 could be a game-changing year for your investments? Experts from Goldman Sachs and BlackRock are forecasting sturdy global growth around 2.8% to 3%, driven by massive AI spending and easing interest rates. But here's the catch: many people will miss out because their portfolios aren't ready. Today, we're fixing that. Why prepare your portfolio specifically for 2026 right now? We're at the start of the year, and the economic outlook looks promising. Recent market data shows the AI revolution is accelerating. Companies are pouring billions into tech infrastructure, boosting productivity and corporate earnings. Interest rates are expected to keep falling, with the Fed potentially cutting to around 3 to 3.5%, making bonds more attractive while keeping stocks supported. Inflation is trending lower, and while there are risks like geopolitical tensions or labor market cooling, the overall setup favors growth. This isn't about timing the market perfectly. It's about positioning yourself to capture opportunities in investing for 2026. Whether you're a beginner starting with a few $100s or intermediate looking to optimize, these strategies will help you build a resilient portfolio. Let's dive into a step-by-step guide. First strategy: assess your current portfolio and risk tolerance. Before making any changes, take stock of what you have. Log into your accounts, brokerage, 401k, IRA, and list your holdings. Ask yourself, what's my time horizon? If you're in your 20s or 30s, you can handle more risk for higher growth. In your 40s or beyond, shift towards stability. A simple rule: subtract your age from 110 to get your stock percentage. For example, at 35, aim for about 75% stocks. Warning: don't ignore fees eating your returns. Switch to low-cost index funds if you're paying high active management fees. Second, build a strong foundation outside your portfolio. No portfolio strategy works without basics. Aim for 3 to 6 months of expenses in a high-yield savings account. Rates are still decent in early 2026. Pay off high-interest debt like credit cards first. It's a guaranteed return. This foundation lets you invest confidently without selling in a dip. Third, diversify across asset classes, the core of any 2026 portfolio. Diversification is your best defense against volatility. Don't put all eggs in one basket, especially with AI hype concentrating tech stocks. A solid beginner setup: 60 to 70% in stocks. Broad U.S. index like S&P 500 ETF, 20 to 30% in bonds for stability as rates ease, 10% in international stocks or alternatives pros of bonds. With forecasted rate cuts, bond prices could rise, providing good returns. Cons: lower yields than peak 2025. Real-world example: in past rate cut cycles, diversified portfolios outperformed all stock ones during volatility. Fourth, tilt toward 2026 growth trends without overdoing it. AI remains the dominant theme. Outlooks from iShares and Morningstar highlight accelerating productivity from tech investments. Add exposure via broad tech ETFs or AI-focused funds, but keep it 10 to 20% of stocks. Other trends: clean energy and nuclear for power demands, copper, mining for infrastructure, or emerging markets showing resilience. Tip: use dollar-cost averaging. Invest fixed amounts regularly to smooth out bumps. Best for beginners in 2026 potentially selective market. Fifth, rebalance and stay disciplined. Check your allocation once or twice a year. If stocks surge, like AI-driven gains, sell some and buy bonds to maintain balance. This forces buy low, sell high. Big warning: avoid chasing hot trends. AI stocks are exciting, but valuations are rich. Selectivity matters. Data shows long-term investors who stay the course beat those who panic sell. Finally, maximize tax advantages. Contribute to Roth IRAs or 401ks, especially with potential policy shifts. To wrap up, prepare your 2026 portfolio by assessing your risk, building foundations, diversifying, tilting to growth like AI, rebalancing, and staying consistent. These strategies position you for the year's opportunities, sturdy growth, tech boom, and easing rates, while protecting against risks. You don't need to be an expert. Start small and consistent. Compound interest is your superpower. The earlier you act, the stronger your WealthForge becomes. What step will you take first today?